Hello, Steve Buser again, a Professor Emeritus of Finance at the Fisher College of Business at The Ohio State University. And now we're picking up with the fourth in a series of discussions on the current state of the U.S. economy. Where we left off, we had talked about the impact of the bursting of the housing bubble on a number of institutions that had not been obviously linked to the mortgage market in any way. AIG was one of those institutions. And when firms in general discovered that AIG was at risk, indeed could easily have failed by virtue of mortgage problems, it made others wonder, well, who else might be at risk? And in the second session, we talked about how vulnerable the economy as a whole was to virtually any disruption in credit markets. And you put those two things together and we have the underpinnings of a financial crisis. We know that some players out there have suffered significant damages due to loss in home values, but we don't know who all is holding those claims. It could be firm A, it could be firm B, it could be bank A, it could be bank B. And the result was, in response to that toxic problem, to back off of investing in any company. The analogy I would draw would be to a Tylenol incident that we had many years ago. It was reported that there had been some poison in Tylenol, and the government stepped in very quickly, identified the product as Tylenol, removed it from the shelf, and was able to contain the problem. Here we've had just exactly the opposite reaction. We've said there's a medication out there over the counter that may kill you if you take it, but we're not going to be able to tell you what type it is because we're afraid that you might not buy that medication anymore. I mean, obviously, if that had been the message that had gone out, people would have stopped buying all over-the-counter medication. So that's equivalent in the banking community. We know that some banks are unhealthy and some institutions that banks might want to lend to are unhealthy, but we have not told the banks which companies are healthy, and we have not told the general public which banks are healthy. As a result, no one knows who to trust, and credit is drying up across the board. In some of these cases, the banks themselves are running out of money because they're unable to get funds. Investors don't know if they can trust the banks or not. Other cases, the banks have the money, but they don't know which of their customers they can trust. The sad thing is that what we do know is that the overall size of the problem is still relatively small. Most of the hit was absorbed by homeowners. When home values decline, if you had a substantial equity in your home, that would be the first line of defense. And the bulk of the decline in home values was absorbed by homeowners. Only the secondary amounts of money beyond the home equity would be at risk for any single mortgage, and most mortgages have not been affected at all. We just don't know which mortgages, and we don't know who's holding the mortgages that might yet be toxic. So we do have a general panic out there, a financial condition that is very severe, probably posing the greatest risk that we have faced since the Great Depression, despite the fact that we said in the first segment, the impact of that on the economy has yet to be really felt. It's a fear, it's a concern, it's a risk, it's not there yet. The good news is that that gives the government some chance to respond in a positive way and control it. And that will be the topic for our next discussion.